This morning delivered one of those moments that makes you stop, stare at the screen, and question whether the market you're watching is even functioning the way it's supposed to. Silver didn't just dip or correct, it collapsed. In barely half an hour, prices plunged from around 121 down to near 106, a drop of roughly 15% before most people had even finished their coffee. That kind of move used to be the sort of thing that defined an entire week, sometimes an entire month. And yet, what happened next is what really matters because by the end of the same trading day, silver had not only stabilized, it had flipped back into positive territory, trading around 117. A market that falls $15 in minutes and still closes green is not behaving normally. That's not volatility for the sake of volatility. That's a system under stress. When I look at this, what I see isn't panic winning. I see two very different markets colliding head on. On one side, you have the paper market built on leverage, derivatives, and promises that can be created or erased with a keystroke. On the other side, you have the physical market where metal has to be dug out of the ground, refined, shipped, and paid for in full. What unfolded today was the physical side pushing back hard against the paper side, and for the first time in a very long time, the paper side blinked. To understand how unusual this is, you have to zoom out. For years, silver was a sleepy asset. It drifted between $20 and $30 for what felt like forever. Daily moves were measured in cents, not dollars. Traders could lean on old playbooks, dump enough paper contracts at the right moment, trigger stop losses, scare weak hands, and suppress the price for weeks. That system worked because physical demand wasn't strong enough to immediately counter it. Today, that reality is gone. We're now seeing $15 intraday swings, and instead of breaking the market, those moves are being absorbed and reversed in hours. One of the clearest signals of this shift is what's happening in Asia. Silver priced in Shanghai has been trading at a massive premium compared to Western markets. Converted into dollar terms, that gap has widened dramatically, reaching around $25 per ounce. That's not a rounding error. That's not noise. That's the market screaming that physical metal is worth far more in the East than the paper price being quoted in New York and London. Spreads like that don't persist in healthy systems. They're symptoms of a deeper imbalance. What's especially telling is the timing of the selling and the buying. Most of the heavy selling pressure we've seen recently has occurred during U.S. trading hours when paper contracts dominate price discovery. When Asia comes online, the tone changes completely. Physical buyers step in, metal gets accumulated, and prices recover. Over and over again, that same pattern keeps repeating. It's as if one part of the world is dumping claims on silver while the rest of the world is quietly taking delivery. This has put enormous pressure on institutions that are heavily positioned on the short side. These entities built their strategies in a world where they could push prices down far enough for long enough to shake out buyers and exit their positions. This week alone, there have been two separate attempts to smash silver prices by roughly $15 each time. In the past, one such move would have crushed sentiment for weeks. Now, after both attempts, silver is still sitting well above where it was just days ago. That's not control, that's desperation. The strain isn't limited to price charts, it's showing up in the real-world infrastructure that supports the metals market. Refiners in the US are reportedly backed up, unable or unwilling to take in more material because turnaround times have stretched and capacity is constrained. Retail-level disruptions are appearing too, with reports of local coin shops pausing purchases, not because demand disappeared, but because they can't cycle inventory fast enough without tying up too much capital. When shops stop buying metal in a bull market, that's not bearish. That's a sign the system is clogged. Even more striking are indications that large mints are preparing to suspend silver sales altogether. When you see refineries jammed, retailers stepping back, and mints shutting their doors, you're watching the plumbing seize up. That's what happens when physical demand overwhelms supply chains that were never designed for this kind of stress. And here's the key point. All of this is happening before any true full-scale short squeeze has even begun. This is just the opening act. So what actually triggered this morning's collapse? It wasn't a single headline or a sudden geopolitical shock. Instead, it was a perfect storm of market mechanics. Excessive leverage played a huge role. Traders had piled into futures using extreme leverage, sometimes 50 or even 100 times their capital. When selling began, Margin calls cascaded through the system. Positions were liquidated automatically, turning small declines into waterfalls. Profit taking added fuel to the fire. Gold has surged roughly 160% over the past couple of years. Silver has risen even more dramatically. After moves like that, it's natural for some participants to lock in gains. Add to that a broader sell off in equities, sparked by disappointing earnings and slowing growth narratives, and suddenly you have a risk off environment where investors sell what they can, not just what they want to. There was also the issue of extreme overbought conditions. Both gold and silver had reached levels that historically invite pullbacks. Markets don't move in straight lines forever. When positioning becomes one sided, even good news can fail to push prices higher, and bad news can hit harder than expected. This was a textbook flush of overextended positions. And yet, here's the part that changes everything. All of those bearish forces hit at once, and silver still ended the day higher. That tells you more than any technical indicator ever could. The paper market threw its entire arsenal at silver, and the physical market absorbed it. That's not strength you can fake. Gold told a similar story. In a matter of hours, it shed trillions in market value, only to reclaim a massive portion of it just as quickly. When assets with tens of trillions of dollars in capitalization start moving like speculative tokens, it's a sign that leverage has distorted the pricing mechanism. It also shows just how fragile confidence has become in paper-based valuation. At the same time, the tone from major financial institutions has shifted noticeably. Price targets that once sounded outrageous are now being revised upward with surprising speed. Expectations for gold have marched from the mid 5,000s to 6,000 and beyond, with some projections stretching toward levels that would have been unthinkable not long ago. The justification is straightforward. Private investors are increasing allocations, central banks continue to accumulate, and traditional bonds are losing their appeal. When that kind of capital starts moving, it doesn't trickle, it floods. Silver, with its smaller market size and heavy industrial use, is effectively leveraged to that trend. That means bigger gains, but also sharper swings. And that brings us to the risks, because pretending they don't exist would be irresponsible. This environment is brutal for anyone using leverage. Intraday moves like the ones we're seeing can wipe out positions in minutes, regardless of long-term conviction. If you're trading on margin, the market doesn't care about your thesis. It only cares about whether you can meet the call. There's also the possibility that broader financial stress could force more selling. In moments of panic, correlations rise. Assets that usually move independently can fall together as investors scramble for liquidity. We've seen this movie before. It doesn't invalidate the long-term story, but it can make the short-term incredibly painful. For physical holders, though, the picture looks very different. Every data point we've discussed points to scarcity, not surplus. Premiums are rising, supply chains are strained, and attempts to suppress prices are failing faster each time. A 15% crash followed by a same-day recovery into positive territory is something this market simply hasn't seen before. It marks a break from decades of precedent. The widening gap between Eastern and Western pricing can't last indefinitely. Either prices in Western markets rise to close that gap, or physical metal stops flowing in that direction, undermining the credibility of paper benchmarks altogether. Early signs of that breakdown are already visible in the form of delays, suspensions, and outright shutdowns across the supply chain. So where does that leave us? It leaves us at a transition point. The old playbook, where paper selling could dominate for weeks, is no longer working. Physical demand, particularly from Asia, has grown powerful enough to overwhelm those tactics in hours. The system is straining in sequence, from refiners to retailers to mints, and major financial players are finally adjusting their expectations to reflect a world where metals play a larger role in portfolios. The unanswered questions are the most important ones. How long can massive premiums persist before the pricing system fractures? How many more aggressive sell-offs can fail before confidence in paper dominance evaporates? And what happens when the physical squeeze that's already tightening finally collides with derivative markets and forces widespread short covering? We're watching a shift from paper-driven pricing to physical reality in real time. It's not going to be smooth. Volatility is the price of transition. But directionally, the message is becoming harder to ignore. Whether you're involved or just watching from the sidelines, this is one of those periods that will be studied later as a turning point. Stay rational, understand your risk, and don't confuse noise with signal. The shakeouts may not be over, but the underlying story is getting clearer by the day.